We're going to talk about defining goals today, and we're going to talk specifically about defining your retirement goals. So, why is this a different situation than the rest of your goals? Well, it's different because retirement, of course, is a little bit challenging. Number one, when we normally define a goal, we think about the lump sum that we need. So if we're buying a house, for example, that makes a lot of sense. We know how much we need to spend on the house. Well, with retirement, we need to translate a lump sum into an acceptable annual income, and we need that to last for an unknown amount of time because it needs to last till you die. And of course, we don't know when we're going to die. All right. So we're going to talk about two different things today. And we're going to go through both of those frameworks. So the lump sum needs to translate into an acceptable annual income. We're going to focus on the income replacement rate. The portfolio needs to last until your death, when your retirement ends. So we're going to talk about a safe withdrawal rate. But what we're going to do is we are going to take a little spin on it today and talk about how, if you have a longer period of time until retirement, how you can actually come up with some of these estimates. So we'll sort of skip that question for the group chat. But if you do have anything to say about estimating your retirement, let me know. All right, so let's talk quickly about the income replacement rate. So, of course, when we retire, we are used to supporting ourselves with a job. And of course, as we move into our retirement, instead of an employer paying you, you need your portfolio to pay you. So it's important to focus on how much you need each year. That's why we look at the income replacement rate. So from just a definitional standpoint, the income replacement rate is the percentage of your salary that you need in order to live. And of course, being retired is different than working. So number one, you don't have to save money anymore. So that's obviously chewing up a portion of your savings or of your earnings. Taxes are different. Generally, taxes are dramatically less in retirement. And also, of course, there can be lifestyle differences. So one good place to go look is you can go to paycalculator.com.au. If you'd like to figure out what your income replacement rate is right now. So just give you a little bit of an idea of where you are. So of course, it looks at your marginal tax rate, depending upon how much you actually earn, then looks at what you're, of course, putting into superannuation. And that gives you a sense of what your income replacement rate is. So right here, an example at $100,000, you start out with an income replacement rate of 70%. So that's good news, right? You don't have to replace your entire income in retirement generally. So that's a good place to start. The next thing, of course, you need to do, and we'll talk about some of the nuances around being further away from retirement, but you need to project out what your income will be when you retire. Of course, especially if you have a longer period of time until retirement, you don't know what that will be. Once again, we're just estimating here. We'll spend a little bit of time on estimation in a second. So what are we looking at? We can use our portfolio projection tool to actually do that. So what you do is you put in the rate of return. You would put in the increase that you would expect in salary over the course of your working years. Now, once again, I'm going to give you a couple of techniques where you can do this as you are younger and have a longer period of time for retirement. So one important thing to note that we've got in this big box right here is we, of course, have a graduated marginal tax rate. Basically just means the more money you make, the more you will be taxed on it. So the good news about this is that as you make more money, naturally that income replacement rate that you will need when we're looking at taxes and superannuation will come down. So that is something to remember. So don't just put a blanket salary increase in here. Also think about the tax consequences of making more money because it'll bring that income replacement rate down. So this is something that's generally probably fairly difficult if you have a longer period of time to go until retirement, but you do need to start thinking about any adjustments you would make for lifestyle changes. So lifestyle changes, of course, are anything that makes retirement cheaper or more expensive than your current working life. So, of course, moving to a different location with a higher or lower cost of living would be one thing. Paying off your mortgage, of course, is a huge huge difference in your finances, of course, because you're no longer paying for housing, spending patterns. So there are sort of minor adjustments around spending patterns, around commuting, potentially you're traveling more in retirement. And just remember that your retirement savings are probably not going to be, or your retirement spending is not going to be steady. Most people actually spend more in retirement when they first retire. Then that sort of tapers off as you age and are less active, and then generally goes up a little bit more around end of life. And then, of course, any other additional sources of income. So if you are in a situation where you do have a significant amount of time for retirement, perhaps this is something to skip. If you're not able to actually picture exactly what your retirement's going to be like. All right, so let's just go through a quick example. So let's say, and we did this example back here, we started with right here, $100,000 in salary. We put a 5% increase in salary growth over a 10-year period. That gives us $162,000. So that's our starting point, $162,000. We looked at a provision for taxes. We looked at savings. Then I made a couple just adjustments as examples, reduced expenses in pension in retirement and an aged pension of $10,000. So that gets us down to $91,000. So that's going to give us an estimated retirement replacement rate of 56%. We'll talk about why that matters in a second. But a couple things for people who are still in the accumulation phase of their life and still have a longer period of time until retirement. So obviously, the longer you have until retirement, the less precise you can be in estimating your income. But I would encourage you to still go through this exercise. So just that lack of precision does not mean that you should just not do this, because it has a lot of benefits. And the number one benefit is it lets you start with a baseline. And yes, maybe the assumptions that you are putting into what the rest of your working life is going to look like and what your retirement looks like, maybe those assumptions will turn out to be not valid. But going through and establishing that baseline is going to make it a lot easier for you to course correct as different things change. Certainly careers change, both voluntarily and involuntarily. Lifestyle changes that you can choose to take on or not take on. Having that baseline lets you, when those assumptions change, it lets you to easily pivot your plan. The other thing is, a lot of people make decisions on changing careers, taking a gap in employment, retiring early, without doing any sort of analysis into what the impact will be. So we want to be thoughtful about decisions we make. We go into a decision thoughtfully, then of course it's more likely we're going to be happy with the outcome if we've thought through all those different outcomes. So once again, having this baseline gives you the opportunity to do that. And one thing, I was talking to a friend of mine a couple weeks ago. So she is 30 and she has a ways to go, obviously, until retirement. And, a good technique that I used when I was younger is looked at 5-year windows of planning. So this isn't like, Joseph Stalin 5-year plans, but coming up with a 5-year window allows you to concentrate on some of the 5 years that are nearer term for you, where there is more precision in those estimates. What it also allows you to do is actually make concrete progress towards retirement. And the way that you make that progress is by saving. So remember, when you are younger, savings matter more, because the one thing you can't get back is time, of course. So concentrating on saving when you're younger is the best thing that you can do from an investing standpoint. And then obviously, as your balance grows over time, your focus will shift a little bit. Maybe you'll be a lot more focused on the returns that you need to get. Maybe you'll be a lot more focused on tax planning, all the other things that can help you. It can help you achieve your goal. But when you're younger, it's savings that matter. So came up with this scenario, and I started this person out at 25. And this is somebody with, let's assume, no savings. And what I looked at is, okay, if you're making a 7% return, what is your future outcome at 65? through these different or through saving and investing. And what you'll notice is I try to pattern this after a lot of people's lives, right? So obviously, when you first start, you are making less money. It is harder to save. You'll generally sort of hit that, highest earnings year between 40 and 50, where of course there's more of an opportunity to save. And then generally people in sort of the later parts of their career, their earnings might come off a little bit as they choose to take a more flexible working arrangement, as potentially you hit your ceiling from a career standpoint. All sorts of different things can happen. So what I sat here and looked at is during these 5-year periods, came up with a savings goal per year, and then came up with a return using the same return for all of these. So what this shows you, by the way, is the power of compounding and the reason why you want to start early. So I know this stuff gets very ingrained in people's heads, but you can see 25 to 30, if you just save $7,500 a year, earn that 7% return, you're gonna have $460,000 at retirement. And as you can see, the savings keep bumping up, and this future outcome at 65 keeps going down. Why is that? Of course, that is because of compounding. And I'll show you guys just how I did this. So just so everybody is aware. Let's see. Sorry, sharing my screen. They can still hear me, so some positive things are still happening. There you go. So what I did to run this scenario, I went into track investment. So I'm in Morningstar Investor right now. And I went to portfolio projection, and that really allowed me to do this. So very simply, in each one of these situations, if I'm making $0, right? So each one of these, I'm starting out with 0. Annual perspective, I think the first one I did $7,500 a year for 5 years, right? So what you're basically doing is that's what you're doing between 25 and 30. You're saving. So $38,257 is your outcome. So that's what you should have at 30. So then I can put that in as the starting value. Now we're going to go no savings because I'm just concentrating on what that 5-year amount is. And I'm doing this, I'll have this at 30, right? So that gives me 35 years to go. No, I actually screwed this up. Sorry about that. Shocking, I know. There you go. So that's the exercise that I was just going through. So it sort of shows how you can project out those 5-year increments of your life. And what I do think is helpful is this allows you to sort of break up your retirement into different components, right? So a lot of people, there's obviously base living expenses that you need to take care of. So at the end of the day, shelter and food. So you can kind of take care of those basic expenses that you'll have in retirement, sort of estimate out what you think those would be. Try to hit those and check those off the list as soon as possible. And this does give you encouragement that you are checking things off. Then start thinking about, hey, what do you want to do? What's sort of your dream retirement? So I just put travel down as an example and start thinking about, okay, well, if I can take care of those base living expenses by the time I'm 40, maybe I'll start going into travel or whatever goals you have. And then, the end of your life, perhaps, another goal that you have, if you would like to leave some money to a charity or a child or anything like that, perhaps that's an opportunity. So I always found this really helpful for me because it allowed me to make progress. One of the problems, I think, when you're younger is that the way that compounding works is, of course, most of the money, the monetary gains in your portfolio will come right at the end. Towards your goal because you're earning a return on a return on a return on a return. And so it can be very discouraging that if you have this big target that you're trying to save for from a retirement perspective and you're seemingly not making any progress. So I think that this is a pretty effective way of sitting there and thinking, okay, well, what is the biggest thing I can control? My savings. I will focus on my savings and I'll start checking off these boxes. Now, obviously, everything's still in one big account, but I think it's just mentally a good way of looking at it. Oh, and the other thing I had on here, this big circle here, is people obviously take career breaks. So for all sorts of reasons, potentially to raise children, for example. And I think sort of creating a plan in 5-year increments will allow you to quantify what that career break, the impact that career break would have. So very simply, and I just picked a time period where some people take some time off to have children. This makes a huge impact, of course, right? Because it's generally when you're younger and you have years and years and years of compounding the savings that you are not saving into the future. So what can you do about this? Well, one thing is obviously you can up your savings at different times to try to counteract the impact of this. The other thing is, depending upon your family situation, maybe your partner could save more to make up for what is happening. So there's lots of different options here, but at least coming up with this plan allows you to quantify that employment break. All right, let's do a little review of what we did. We're trying to figure out, and because it's very difficult for people to think of a lump sum, we're trying to figure out how much we need per year to take out of our portfolio to support us in retirement. Well, the next step is we do need to translate that into a lump sum. And how do we do that? We do it with a withdrawal rate. So the biggest challenge that you face when you're in retirement is you spent your entire life saving and investing, and now you've reached a point where all of a sudden you need your portfolio to support you. So you need to start taking money out of it. And when you're determining how much money that you're going to take out of your portfolio, you're faced with two risks. So you are faced with sequencing risk. And that is the risk that not the average returns you get, but the order of those returns is unlucky. So basically what that means is the market falls significantly right as you retire. And then longevity risk. So that is the risk, of course, that we talked about at the beginning of this, that you don't know when you're going to die. So it's very difficult for you to plan without knowing the end date of your retirement. So the longevity risk just refers to the fact that you could outlive your money, which people are obviously justifiably worried about. All right, so let's spend a second on both of these two risks. So we've got sequencing risk. And as I said before, markets going down, your portfolio going down in value significantly in the early years of your retirement or right as you're transitioning into it can be a huge problem. It will dramatically impact the amount of money that you have in the future. So let's use two examples of this. And basically this is bad luck, right? It's saying that, well, the average return is important. You could have the bad luck of retiring in a terrible market. So we have two different scenarios. So 20 years, a $500,000 portfolio invested in the S&P 500, so 500 largest shares in the US, with $20,000 a year withdrawals. All right, so these are just retirement, two different retirement scenarios. So scenario A. So we looked at the actual return. So this is somebody who retired on January 1st, 2000. So they woke up, found out Y2K was a hoax, and then started their retirement. So these are the actual returns. This is their portfolio. Starts at $500,000. And these are the actual returns of the S&P 500 with those withdrawals occurring every year. So where do you end up after 20 years? Well, in scenario A, you end up with $165,000 left out of your portfolio. Then we took scenario B. So all I did here is I reversed those returns. So 2020 returns occurred in 2000, 2019 and 2001, et cetera. So same exact average return over those periods, simply reversed. So where do we end up now? $782,000. So for people who know market history, retiring in 2000 turned out to be a really, really bad thing because very weak markets. Over the decade from 2000 to 2010, the S&P 500 was actually negative for an entire 10 years. I mean, the first 10 years of your retirement, which included the dot-com crash, included 9/11, included the GFC, really bad decade, really bad start to your retirement. So you can see the impact that it has. So once again, if you are younger and you're sort of looking at what's happening in the market right now, it's not necessarily a bad thing for you. So when do you want crappy returns? You want crappy returns during your sort of peak earning years where you can save as much money as possible. You don't want them when you retire. Then longevity risk, of course, is the fact that you can run out of money before you die. And the problem is we don't know when we're going to die. So we hear a lot about averages in terms of what is the average lifespan. And that's great. But if you have the fortune to live longer than average, the misfortune could be that you run out of money. So that's a difficult thing to do. So right here we have probability of dying at each age for a 65-year-old man, and you can see we've got an average on here, right? But there are a lot of outcomes that are well beyond that average year. So that's longevity risk. That you don't know when you're going to die. So the problem that we have with these two different risks is what you do to actually mitigate them are actually contrast with each other. So longevity risk. So what do you do if you're worried you're going to run out of money? Well, you need to stay invested in growth assets. So growth assets like shares, listed property, infrastructure, things like that. You want to stay invested in those because over the long run, they have higher future expected returns. So you want to stay invested and want more of your portfolio tilted towards growth, right? Higher returns over the long term means that you will start to be able to support yourself if you go past average and you're sort of in the tail end of that distribution of when people die. Problem, of course, is sequencing risk, which is the risk that your portfolio will fluctuate significantly right at the beginning of retirement. What do you want to do to combat sequencing risk? You want more defensive assets. They're going to bounce around less in price. There's going to be less volatility associated with them. So that risk mitigation technique is obviously exactly opposite of longevity risk. So the way that we address this is we need to pick a withdrawal rate from your portfolio that helps you with both. So it means that it allows your portfolio, you're not taking out too much. So your portfolio can deal with a situation where you may live longer than expected, but you're also not taking out, but you're also allowing yourself to get through those, the potential that you have bad luck early in retirement. All right. The 4% rule is something that hopefully most people have heard. So the 4% rule came from a financial planner named Bill Bengen, and all his clients came in and talked to him about this problem that they have. They didn't know how much to take out of their portfolio. And he, of course, knew that longevity risk and sequencing risk were the two things that were facing them. So he said, why don't I go back and do a study? So what he did is he looked at returns between 1926 and 1992. Picked 1992 because he did this in 1994. And that, of course, was the data that was available. And he looked at a 50-50 share and bond portfolio. And he basically, to combat sequencing risk, he looked at every historic return combination between 1926 and 1992. So it's called the Monte Carlo simulation. He ran all these different simulations. So that was to take care of sequencing risk, to saying even if you retire in the worst possible time, where you've got the worst year of you got 1929, right before the Great Depression, you've got the dot-com crash, you've got the GFC all sort of stacked together in terms of returns, the worst combination that could happen. What's going to happen to your portfolio? Then he had to deal with longevity risk. So he defined longevity risk as 30 years. So just remember, these are all the assumptions in here. So he thought that 30 years covered the outcome of the vast majority of people in terms of retirement. What did he come up with? Came up with a 4% rule, that 4% was a safe amount to withdraw from your portfolio. And we're trying to answer that second question. How do I translate a portfolio into income to support me? Question is, does it still apply? Now, the problem, of course, with what he did is that he was essentially saying, the assumption in there is that the future will look like the past. That looking at this return period from 1926 to 1992 was an appropriate way to think about the future and what was going to happen with returns. So this is, of course, called back testing. And back testing has, a pretty bad connotation in financial services because, of course, we know the future is, number one, unknowable, and also sometimes does not resemble the past. So that's one problem. The other problem, and what our researchers looked at here at Morningstar, the other problem is we are in a very, very different market environment than pretty much anything that happened between 1926 and 1992. First of all, bond yields are extremely low, starting to go up, right? The Fed will raise rates this week. So maybe we'll see this starting to creep up, but still, bond yields are the lowest they've been in the past 70 years. Share valuations are the highest they've been in the past 70 years. And higher valuations generally mean lower future returns. That's, of course, because there are three sources of returns: dividends, growth in earnings, and changes in valuation level. So you don't really have much room for valuation levels to change at this point. The other thing, and this is a positive, is inflation. So one important thing about Bill Bengen's 4% rule is that every year the withdrawals are increased by inflation. So you take 4% out of your portfolio the first year, and then after that, you'll adjust that for inflation. Now, inflation is still low, I guess. We haven't quite gone through a whole year yet of high readings, but historically it has been very low. So inflation adjustments have been low. Now it looks like that's changing, which makes the current environment even worse. So what Morningstar did is they went through and they projected out future returns and different inflation scenarios, and using the same assumptions, 30 years, the fact that you'll increase your withdrawals by inflation, same assumptions for a portfolio in terms of asset allocation. We came up with this report, Morningstar State of Retirement Report, which is on our website. We'll send it out to everyone after this. Shawnee took this research and wrote this great guide that puts it in an Australian context. And basically the conclusion of the research is that the 4% rule needs to be lowered, given the situation we're in. It needs to be lowered to 3.3%. What does this mean? Well, what it means is you need more money. We'll talk about how you can sort of handle this situation. But of course, 3.3%, you're taking out less of your portfolio. Now, the way the math works is pretty simple, right? We've come up with how much we need in that first year of retirement, right? That income replacement rate times your income gives you an amount. We're going to use $40,000 as an example. Now, to figure out the lump sum that you need, all you need to do is divide that by the withdrawal rate. So $40,000 divided by 0.04 is $1 million. $40,000 divided by 0.033, a 3.3% withdrawal rate, is $1.2 million. So you're figuring out, as I'm sure you intuitively know, the problem with this is if the withdrawal rate goes down, you need more money, assuming you're supporting that same lifestyle. So something very important to think about. Now, this probably makes less sense if you have longer time to go to retirement, but the thing you can do to make an adjustment is you can consider a more flexible withdrawal rate. So the withdrawal rate that we were talking about was a fixed real withdrawal rate. So taking the same amount out in purchasing power of money, right? That's why we're increasing it by inflation. But you can also have a flexible withdrawal rate. So basically what a flexible withdrawal rate says is that if market conditions change, the amount of money you take out of your portfolio changes. Now, this should make sense. Basically saying is you're not going to take the same amount out if the market goes down a ton. The problem, of course, is that this is your life. And most people don't really want their retirement impacted on a year-to-year basis based on market movements. Of course, the market can be very volatile. That means that if the market goes down, maybe you can't go on the vacation you wanted to go on. All sorts of different implications. So yeah, something to think about with that. And there's a couple different withdrawal rates, and Shawnee goes into them in detail in this report. So I won't go through them all, but they're all the same thing, right? Not taking inflation adjustments, okay? So Now you're not taking more out. That means your standard of living could decrease. Required minimum distribution. So that's basically looking at a formula of how much you're going to take out. Guardrails, you will adjust it if the market goes down, but not by too much. You'll have a set lower limit on how far down it would go and a set upper limit, depending upon market movements. And then, a very simple rule of thumb. Every time the market goes down or your portfolio goes down in value over the course of the year, you take out at 10% less. All right. And all of these, of course, and this is in the report, all of these, of course, mean different withdrawal rates. So depending upon which method you use, you can support higher withdrawal rates, which of course means that you can get more money out of a similar portfolio. Or if we look at the other way, you need less money in your portfolio to support your lifestyle that you've defined. All right. So let's bring this together. And this is where we'll talk a little bit about how we can put a range in here. So once again, in summary, what do? So we calculate our income replacement rate. So we look at the current percentage of our salary, adjust it for what we think, or our current salary, then we adjust it for what we will need in retirement. So once again, those can be lifestyle adjustments, it's adjustments for taxes you pay, adjustments for savings that you have. We come up with an income replacement rate. Then we make an inflation adjustment on our salary or any sort of adjustment you want. So if you think you are going to make that the increases in your salary will be higher than inflation, you can adjust it higher. Think they'll be lower than inflation, do that. So we can make that inflation adjustment. So this is once again where we can focus on maybe a 5-year increment. So obviously you will have more insight into the 5 years that are closer to where you are now than the future, but this is an opportunity where we can do that. And remember, we talked about how making just an estimate is good and establishes a good baseline. Then calculate your withdrawal rate. Now, this is where I would say that, I went through a very specific market situation right now, if you were retiring right now. But of course, conditions are going to be different when you actually do retire, especially if you have a longer time to go till retirement. So what I would recommend is putting a range on this, right? You don't have to be as precise because you have longer until retirement. So put a range between, let's say, 3.3% and 4%. And that will give you a sense of how much you need for retirement. So in this case, using the $70,000 a year retirement, you need between $1.75 and $2.12 million. Give you a range, once again, is acknowledging that you cannot be precise about what market conditions will be like when you're older, but also giving yourself an idea of, okay, what are sort of my retirement savings goals here? And how can I make other adjustments in terms of how much I'm saving, what my asset allocation is, et cetera, to try to hit that goal. All right, a little disjointed, but we did it, and we actually are still early. So no questions. We have a very silent crew today, probably because I screwed this up with the sound. But if you do have any questions, you can send them through. You can also send any questions to mark.lamonica1@morningstar.com. So it's the email address that is in this invite. And we will send out a copy of this recording, hopefully edited out of the beginning. And then we can, and then you can watch that again. We'll send the materials, and yeah, that will be in your mailbox hopefully later this afternoon. So anyway, thank you guys for joining. My mother joined. It is her birthday. Well, tomorrow in Australia, Thursday in Australia in the US. So happy birthday, Mom. Thank you for joining. And anyway, I apologize for all of the issues with the sound.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.